Welcome, everybody. For those of you who don't know me, I am Tom Schmidt. I'm one of the principals of Ticker Tape Investments, along with Rita Carpel. And we're here today, of course, to talk about Trump's new tariff structure and what it means, what they're trying to accomplish, and how investors are reacting to it, or should be reacting to it. So without further ado, let's talk about the roadmap of what we're going to talk about today. I'm going to give you kind of a quick overview of what it is they're doing and why, what their rationale is, whether you agree with it or not. We'll talk about the short-term and the long-term impact on the economy, the world, the stock market, etc. And then kind of boil that into an investment strategy adjustment. Ideas. I'll give you a couple stock suggestions that you can look at, as well as talk about private equity and kind of what the new investment landscape looks like. To start, this is a kind of super quick overview of what apparently is a very complicated structure. The idea is that the United States is imposing an across-the-board 10% tariff on all imports into the United States, all countries. That they call that the baseline. Well, when you use the word baseline, that means that's imposed, but then of course you can increase it or decrease it as you want to. Then particular countries have what they're calling a reciprocal tariff structure applied, and they created a formula that I haven't verified this, but it seems to me to kind of be a loose interpretation. Effectively, the more trade imbalance that the U.S., the higher the tariff rate would be. But there are some different industries, etc. On the chart there, I put a couple of examples: China, European Union, Japan, Israel, and what the specific tariff rate is for that country. And so there's a whole list of them. You can go look if you're interested in a country by country analysis. And then they're applying additional duties onto particular industries. Semiconductors is 25% and more. Solar is 15%. I believe that's only importing solar panels, but it could be other solar equipment as well. Consumer goods have tariffs associated. And of course, there's a 25% automotive tariff, where they're imposing tariffs not only on cars that are imported, that is made in other countries, but also on car parts that are imported either for repairs or for vehicles that are assembled or manufactured in the United States. And so very aggressive set of tariffs. Now, a couple things here. First of all, the idea is that if, for instance, the European Union were to take actions to change the trade imbalance with the United States, then those tariffs would decline. The second component is, of course, as we all know, Trump's book, The Art of the Deal. He's a deal maker. He's looking to go negotiate these U.S. and particular country relationships in order to get some sort of concessions from those other countries. Now, why is the United States doing this? I thought about a lot of different ways to approach this for you guys. I'm going to approach it from the standpoint of a tariff increase and why the United States might implement a tariff increase. Of course, these things could be modified to specifically address the nature of the tariff plan that Trump brought in. But I think we're going to have bigger, more additional programs implemented, changed, etc. So I think it's better to kind of understand the bigger issues. And the biggest one, of course, is we have a massive national debt. And it is my opinion, and a lot of people have been writing about this online, in the media, etc. It is my opinion that what's really driving this is a very serious concern on behalf of the Trump administration, in particular economists and investment banking leaders, and sort of the most important guys in dealing with the U.S. economy, being concerned about our national debt and how do we get that debt down. And I think really that's what's driving a lot of these efforts by the Trump administration. Again, bigger picture, not just what he announced on Tuesday, but kind of the overall approach. So one of the things they're trying to do is reduce the U.S. debt. And Trump has said many times that he, both during the campaign and after the election, that he would love to replace the income tax with tariffs, which of course is not reasonable, never going to happen. And you know, the CNN or the media, you know, oh, Trump's lying. He knows that, you know, well, he's not lying. He's exaggerating for a reason, right? He's playing games to convey messages to the masses and to other countries that, you know, we're going to change some of our focus to this approach. And so part of the strategy is to raise capital from the tariffs and potentially replace some of our income taxes with this money. Another, you know, big component of it is this notion that for the last 50 years, an enormous amount of wealth that the United States created and accumulated has been shipped out all over the world to other countries, that we've effectively been financing or supporting or subsidizing economic growth in other countries. And that comes from this notion of trade imbalances and tariffs being imposed by other countries that are much higher than the tariffs that the U.S. charges. So this economic nationalism idea, the idea of changing trade imbalances, and then last but not least, of course, is the concern that U.S. manufacturing has moved offshore, and we need to get some of that manufacturing back onto U.S. soil. So let's talk about debt reduction, and this is really what I think is driving these tariffs. And a lot of people, I had a friend posting on Facebook today about the dollar amount, the trillions of dollars that were just wiped out of the stock market today by this announcement. And certainly that's something to trifle about. It's very serious. It's very significant. Those of us with retirement accounts that are invested in the market took a hit today. And I'm not trying to downplay that, but I think that was intentional. I think what's happened since Trump came into office with the stock market, I think there's a little bit of glee going on behind the scenes of the administration, because we are in a situation where I believe the number is $9 trillion of U.S. debt has to be refinanced this year. And so the higher that interest rates are, the more interest that we, our kids and our grandkids, are going to pay on that debt. And so the idea is, if they can drive down the stock market, cause investors to pull cash out of the stock market and put it into bonds, thereby driving up the price of bonds and driving down interest rates, they can then refinance the U.S. debt at a lower interest rate. And these guys are smart, man. One of my favorite stories was Treasury Secretary Paulson, when he did the bailouts during the Great Recession. For the first time ever, you had the United States government engage in activity to make money. They literally gave money to GM, they gave money to banks and all these things, and they got more money paid back. It was a net positive for the U.S. It wasn't a traditional bailout where they just give the money and we never see a benefit from it, or giving money to Ukraine for them to defend themselves and the U.S. not getting anything back in exchange for that money. And the Trump administration, and I think it's much bigger than Donald Trump, that's why I keep saying administration, this new philosophy of let's do things that are long-term better for the United States and for our economy. And so look, they're looking at, man, we can do this, we can increase tax revenue, we're going to use that to take a bite out of the United States federal budget deficit this year, next year, the following year, and combining that with the DOGE and the other expense reduction efforts that we've made, we start getting that deficit down significantly, which again puts downward pressure on interest rates. Again, that short term, all that money that's leaving the stock market, when you see a stock go down, that's because somebody sold it at a lower price, right? So if they sold it, what they do with that cash? Most of that cash ends up going into the bond market, particularly treasury bonds, if there's fears of market declines, and that drops interest rates. And so when the U.S. is out there selling bonds to refinance the debt, they get to sell them at lower interest rates. And I believe what I've heard online and out there in the media, that this is deliberate by the Trump administration. They're very well aware of this short-term benefit. And of course, part of it is weakening the US dollar, which helps reduce the trade deficit, allows more wealth to stay in the United States or come back to the United States, et cetera. And then of course, you've got clearly one of Trump's main objectives is to get more foreign investment in the United States. You've seen massive investments announced by various companies, by Saudi Arabia and the UAE, making trillion-dollar investments in the United States. And what does this do? This starts bringing that wealth back into the United States, creates jobs in the United States. And so all of these factors add together to help reduce long-term U.S. debt, take some of the pressure off from the refinancing, and save us interest over time. So what are the immediate market impacts that everybody's going to see? You won't be surprised to see these. Of course, the one you'll hear the most about is the price increases. You're also going to see market volatility. You're also going to see potentially other countries rattling their sabers. And think about it, just kind of use your common sense. What would happen if other countries started imposing higher tariffs on U.S. exports? They can't compete with us. We're the wealthiest country in the world. We buy the stuff. We make all services, by the way, that other countries have to have. And so what the Trump administration is trying to do is an environment that allows U.S. companies to compete overseas and incentivizes not only U.S. companies, but foreign countries or companies to invest and manufacture things in the U.S. The one issue that I really worry about is supply disruptions, right? So there was a CEO on TV today saying that they make wicker baskets, like hampers and baskets that you might use in your house, along with lawn chairs. And he said, you can't move that manufacturing to the United States. It's not a matter of it would be more expensive. There's just no people who are going to, first of all, no one's going to build a factory in the United States to manufacture wicker baskets and weave the plastic into to make the baskets. It's just not reasonable. So what that means is if you impose I think he was saying possibly there's a 79% tariff. Basically, either you're going to pay $80 for a lawn chair, which I don't know that people have, or you just don't buy it at all. And so what's going to happen is these products just aren't going to make it to the market. So things are going to happen. You can't really quantify that much. Obviously, there's a reduction in economic activity, but I'm not sure that if the United States buys less lawn chairs from China, it's really going to have that big of an impact. But it does affect quality of life. It makes business hard, creates stress, and all those things for businesses. Couple of little statistics I wanted to show you guys. One is the recent trend in interest rates. This is, where are we? We're on the fourth. So this is a 5-6 day chart of the 10-year Treasury bond. And you can see it was already declining. And then all of a sudden that precipitous decline is Trump's tariff announcement on the 2nd. And it is started falling off a cliff. And of course, again, this is exactly what the Trump administration wants, because we are a seller of debt. We want the debt to be more valuable and pay a lower interest rate, and the U.S. is better off. These numbers are really rough. They are perhaps a little bit rosier, in fact, than the I want to talk about the long-term outlook for this thing, because it is my humble opinion that on balance, over time, the United States economy is going to get an enormous benefit from this program. Of course, one scenario is that Trump uses this to negotiate all kinds of individual deals with different countries, and the tariffs come down, but we get economic benefit, we get a reduction in the trade deficit, we get more U.S. exports being sold in other countries. All those kinds of things would be great, and we'd be excited if those things happen. But even if you assume that the tariffs stay in place, I believe personally that the negative connotations that you've heard, people bashing the Trump administration, bashing this program, they're not wrong. I think they're just overstating the significance of these factors, and they're not taking into account time frame, which is who will rise, who comes next, what happens with Congress. Will this approach continue or not? But if it does, I believe you're going to see increase in job creation, more middle class, resource security. Two things I one was to healthy. All of our antibiotics come from overseas. So we got to build manufacturing capability, oversimplify everything. China, well, so we need to move the manufacturing to Vietnam. Well, imagine a World War III scenario where the West goes to war against China. Vietnam isn't going to exist. Taiwan isn't going to exist, right? China's going to swallow those up almost immediately, potentially even. So if those are your only places to get access to these kinds of things, you got a real problem. So there's a lot of industries that we need to be developed here in the United States. We need to reduce our trade deficits, and we need to have a lot of our capital repatriated to the United States, not just our capital repatriated, but also new capital from other countries, et cetera. The little handouts that you get in trade shows, 63 cents a piece, all those sort of things are going to become a lot more expensive. Are artificial intelligence based computer systems going to be that much more? No, I don't think so. Are fancy luxury vehicles going to be that more expensive? I don't think so. But some of the less expensive things, the things that are manufactured in some of these countries like Mexico, China, India, et cetera, may go up in price. The issue is the supply chain instability. Things in the United States, we have to build that, and that takes time. So what do you do in the meantime? Do you just pay the 30% higher price? Do you not buy it at all? If you are a manufacturer in the United States who buys ingredients, if you will, components overseas, and all of a sudden those components dramatically increase in price, and there's not an alternative domestically, what do you do? So all of those things come into effect. And then, of course, my confidence is in the Trump administration's ability to negotiate and manage through these kinds of the bull market. Certainly the bull is full transition with strong manufacturing growth, new jobs, more jobs coming to the United States, more national security protection where we have domestic sources for key things we need to operate self-efficiently. There's obviously the scenario of you go to war with the country, now you can, but imagine, things like in World War II, one of the biggest problems was the United States had trouble getting supplies over to Europe because of all the German submarines. Well, imagine if all of a sudden the United States and China went to war, we have much more advanced submarines that can eliminate all shipping. It doesn't matter. Things come here from the UK either. And then, of course, there's sort of the COVID scenario where, you know what? It doesn't matter. There's no war. Everybody's at peace, but you can't bring ships into the United States. And you have that sort of problem times 5. All of a sudden, we've got bigger issues. And so those are all things, reasons why we need reshoring and how we'll benefit from that. Of course, there's always the bear case, which is economic friction, some sort of trade war with persistent cost inflation and reduced global growth, certainly a risk. But if y'all have heard me talk on any of these presentations, you know I'm all about the bell curve, and the most likely result is something in the middle. I think you see some short-term economic decline, hopefully offset by other economic benefits like tax reductions, like energy cost reductions, right? If the cost of everything else goes up, but the cost of oil goes down, which by the way dropped 7% today, then you end up getting an offset of the overall cost increases. And that's the most likely result, is sort of something in the middle. Okay, let's talk about how you navigate it. What do you do with your investments? What are we looking at? So, secondly, which is outside of the public markets. But if you're looking at companies, generally speaking, you want to watch out. Okay. So watch out for vulnerable sectors, technology companies that have global supply chains, automotive manufacturers that are going to have parts shortages, of course, importers, all those kinds of things, consumer goods brands with offshore production. On the flip side, look for domestic manufacturing, particularly markets that are where there are tariffs that benefit domestic production. Energy producers have been gaining policy support. Now, again, if there is a extended sort of recession, then you would expect oil and gas and energy demand to decline. So you'll see a negative impact on those stocks as well. But keep an eye on those, certainly an area to watch in the coming months and years. And of course, AI and automation solutions, we'll talk in a minute about trends and some of the bigger trends that likely will override the impact of some sort of trade war or increase in tariffs. And then, you know, again, you're going to see lots of volatility. The market went down a bunch today. It's likely to go down again tomorrow. Then you'll see a significant bounce, and then it'll settle, and it'll end up probably declining over time. So watch out for that. Watch for sector rotation. And of course, you're going to have compression in profit margins, which if the multiples stay the same, you would expect stock prices to come down. So those are kind of the things that you want to be watching out for. Companies you want to look for, things that are recession proof, right? Look for investments that tend to outperform in recessions. You'll see lower end services, discount retailers, healthcare industries tend to do well, pharma, hospital companies, things that aren't really affected by recessions or imports in this case. And then of course, consumer staples. Everybody's got to buy toilet paper. Everybody's got to buy cleaning products, food products, all those sorts of things. Number 2, look for companies where they're either making things or buying things and reselling them within the United States. Those companies are going to be less impacted by this on the negative, and they may end up getting a significant positive impact, because if you're competing in an area where most of your competitors rely on imports and all of a sudden their products just got 10 to 25% more expensive, holy cow, the domestic company is going to have significant growth. Again, big trends: AI, aging population, demand for cheap housing, these sorts of things, robotics, these sorts of trends are likely to overcome any setbacks from tariffs, et cetera. So watch out for that. And then y'all won't be surprised to learn that my 4th point is look at private equity, stay away from market volatility. But having said that, taking into account all the stuff I've already said about public stocks too, right? Pay attention to trends, who's buying American, who's coming in to build something in America, etc. Stock ideas. So bunch of these, lots of ideas here. One that you may have heard me talk about in the past was Palantir. This was actually a ticker tape pre-IPO stock that we sold when it went public. It went down after that. I ended up buying some. I wrote it back up. I think it's in one of my investing clubs that I'm in, owns it, has a nice profit. But this stock has rallied significantly. I think it was up in the 120s, recently fell back to around 80. When I recommended this stock, I think it was about 4, 5, 6 months ago, my recommendation really was, look, I like the company. I think long-term it's got a fantastic trajectory in front of it, but it is something of a recession insulation device in that most of its sales are to the US government. So mostly the military, frankly. And so if the economic activity in the US declines, their business is not likely to decline. Now, a little bit of concern over Doge and this new trend of reducing government spending, but my belief is that the services this company provides are so valuable and going to become more valuable in the future that it will be one of the last things that would get cut. And so a believer in that stock. CarMax and Carvana, obviously if tariffs are imposed on new cars that are imported, most of the cars in the United States are either imported entirely or they are manufactured in the United States from imported parts. If new car prices increase significantly, you would expect used car prices to increase also, as well as demand for used cars to increase. So CarMax and Carvana are really good players to play that market if you believe that that's an industry or a sector that is likely to increase. I believe both those companies are pretty good. CarMax a little less exciting than Carvana outside of the tariff context, but they're both down significantly today. CarMax down 7%, Carvana down 20%. I think there were a lot of stocks that were hammered because of not tariffs, but because of concerns about recession. Hey, the tariffs are going to cause a recession, and therefore people are going to stop buying cars. So I'm not buying it today or tomorrow, but I'm going to watch these, see what happens, and I may use this as an entry point for one or both of those companies. Walmart, Dollar Tree, or TJ Maxx. This is another example, another opportunity for me to talk about when we were operating the sightseeing tour company, Onboard Tours in New York and Washington, D.C., in 2007 and 2008, our sales went up, even though the United States was going into a recession. And after the fact, I told people for a long time, I'm like, I don't understand. Like we're a high-end tour company, we're the highest priced product in our market segment. Why did our sales go up so much? And when we looked at it, what we figured out is it was just shift in the market, right? The people who had the segment of society that had bought our tours the prior year stopped traveling on vacation. They lost their jobs, they had, budgets were tighter or whatever, so they stayed home. But the people who had made too much money were traveling in prior years to Europe or Asia and had very expensive, lavish vacations. They had to tighten their belt too. So instead of going to Europe, they went to New York and bought tickets to, guess what, the highest price tour in the market. And so I think these companies, things like Dollar Tree, TJ Maxx, and Walmart, I like them for a couple reasons. Number one, yes, the customers they had last year may have a hard time paying the higher prices that come from the tariffs, but I think you're going to have higher dollar customers that are going to move down that food chain to discounters rather than premium retailers because of potentially a recession. Also, I think I've read, I believe that these three companies are insulated better than their competitors against these tariffs, right? So even if the entire retail industry were to decline, these guys should outperform, and so they're worthy of consideration as buys. last is Meta. I think this company is crazy cheap. I don't buy that there's going to be some sort of massive US domestic recession that hurts advertising prices either in the United States or globally. Companies like Meta, the Trade Desk, Google, or Alphabet, I guess it's called, have been getting hammered on concerns about declining advertising. I'm just not a believer in that. So I made some money on Meta over the last 12 months. I don't remember when I sold it, but it's been a while. Maybe like December I sold it, I think. So I'm definitely looking at buying this one back. I think if for no other reason, just the multiple. Go look at the price to earnings multiple on Meta, and I think it's a good place to move some money in light of what all is going on. But again, get into private equity. If you haven't seen my presentation about how the ultra wealthy invest, billionaires and multi-$100 million investors put more than 50% of their portfolios into private equity. Why is that? Well, number one, it outperforms. Number two, there are tax benefits depending upon how you play it that you don't get from publicly traded stocks. Number three, it's not subject to market volatility, right? The same business that's privately held, if there was one, maybe there is, I don't know, that competes with Carvana did not go down in value 20% today. Carvana did because there was fervor in the market to sell stocks, right? And because private equity, private companies can't be sold, they're not subject to those crazy swings. You can literally look at the value of the business and invest based on that. You kind of exclude one, or certainly massively diminish the impact of one factor that makes investing difficult. We love that. I love the ability to diversify, lots of unique opportunities that you can't get in the stock markets. And then, of course, to the extent that you can play a role in management, whether advisory or otherwise, that to me is an added benefit. I think you're going to hear in the coming weeks that smaller companies are more able to adapt to big changes in the market. And so if you're on the theory that if you're investing in private deals, they tend to be smaller, you're going to have more ability to move and adapt. But same sort of things, same sort of things driving investment decisions here that would for publicly traded stocks as well. You want to be non-correlated, right? Not only to the stock market, which is what we normally talk about, but also to the economy, right? What about an urgent care center that we invested in? What about multifamily properties that are less dependent on economic growth, right? Look at non-correlated assets. Oh, litigation funding, of course, would be another great example. Increase your US. Now, we all have to kind of pay attention to this in the near term. Hey, I'm investing in this company or I'm buying this stock. What is their exposure to these tariffs? Are they buying everything in the US? Are they importing anything? Where are they making it, et cetera? It makes a big difference. Optimize your tax efficiency. Again, this is critical. We've done presentations on this about where you should place investments. Had an investor call us the other day, somebody who had not invested with us before, saw our presentation and called and said, oh my God, I put all my multifamily investments in my IRAs, my self-directed IRAs. Am I now going to have to pay UBIT tax? And the answer is yes. So make sure you pay attention to that and you optimize tax efficiency there. And then look at income producing deals, right? There's a lot of benefit to this, but one of them I don't talk about very often is if you have an investment that's generating income, it tends to, just by definition, it's likely lower risk, right? Because I put in 100,000, if I only get a $3,000 distribution back, I'm now only out 97,000 if something goes wrong. Then I'm only down 94,000. Then I'm only down 91,000. So it's reducing the risk of your investment. And in uncertain times, that's a great strategy to follow. Areas to look at: pre-IPO deals. We love these. We think that There's going to be some short-term disruption here because I doubt any companies will be going public in the next 60, 90 days. You'll probably hear of companies delaying IPO plans that are already on the books because of the market volatility, but that's not going to affect us, right? We're looking at a 6-month to 2-year time horizon, so we'll continue looking at pre-IPO deals. Domestic infrastructure, I don't have any of these deals on our radar screen right now, but we're going to start looking for them, rest assured. We're going to be looking for deals to benefit from new investment in the United States, companies manufacturing things in the United States, et cetera. Artificial intelligence, automation, data centers, software companies, all of these tier 3, tier 4 companies in the AI revolution, all still great places to go. With a little footnote, watch out for recession impact. And usually you can sort of get, zoom out, bigger picture and say, you know what, this thing may suffer through a recession, but when we come out the other side, that company's going to rock and roll, and I'll be investing in it before the stock gets, before it goes public, so it doesn't have the impact of that recession on it. And then, of course, reshoring initiatives. It's a little early for this yet, but look for these opportunities over time. If you want industry advice in these areas, the way I think about it is, number one, think about industries where the US is dominant. Why is that important? Number one, we're making the stuff here, so we Americans can buy it at the same price, but we're exporting it and other countries have to have it, right? So if you're making, let's just say, Tesla electric vehicles, and I don't even know if Tesla exports from the US, they probably export from Berlin and China more, but let's say hypothetically, another country goes, hey, you know what, we're going to put tariffs on those Tesla cars because we don't care. We can buy other electric cars, Volkswagen or BYD or whatever, and so we don't have to have the American Tesla brand. Well, if you're NVIDIA, on the other hand, and the chip that you need a particular AI chip that's manufactured in the United States, they're not going to put tariffs on those chips because they got to have them, right? So the things where America is already winning, those are great markets. And then the other end is the areas where we're not winning, but we need to be, right? So this is the reshoring thing, things where certain industries are going to have to come back to the United States. Look for those companies that are implementing that and make sure that that you take advantage of those. Final thoughts. The number one, I know probably a bunch of you guys were selling stocks today, being conservative. I point you back to what Warren Buffett said. I think he said this during the COVID decline, but it might have actually been the Great Recession. Never underestimate America. He said, you can't go wrong investing in America. And so I think this is as true today in light of the tariff programs as it was during COVID, as it was during the Great Recession before. This country should emerge stronger with a better fiscal situation, a lower long-term national debt, more manufacturing domestically, more foreign investment in the United States. So never underestimate America. It's a little late now, maybe, but always keep dry powder. Again, something we talk about at Ticker Tape, maybe not enough. May always have dry powder. I happen to have done a pretty good job. I've been selling some stuff personally in recent months. We obviously had a little liquidity from utility rescue and from the litigation deal. So I do have some dry powder that I plan to use to take advantage of this decline. Always make sure you have cash on hand. If you feel like stocks are running up and you start patting yourself on the back for making good investments, it's probably time to start taking some money off the table. There is always opportunity when you have disruption, so look for those. Most of y'all know my story about when I was playing blackjack on March the 17th, 2009 at the Bellagio, and I sat for an hour and a half playing at a table, never said a word. Guy next to me sits down and he says to the dealer, you know, a share of MGM stock today costs less than a cheeseburger at the Bellagio. And it took me about 5 minutes sitting there thinking about it. And I pushed in my chips, went upstairs, liquidated my entire investment portfolio of publicly traded stocks and mutual funds and all that stuff. And I started buying the companies that had most been disrupted, including MGM casinos, because I said, you know what? Again, Warren Buffett's idea, this too shall pass. In March of 2009 was the low in the stock market. I said, you know what, enough's enough. This stuff's going to start turning around. So in disruption, look for opportunity, and then position yourself for what's next. Again, we encourage you to increase your private equity investments to take advantage of those things. That's all we have for tonight. I already ran longer than I wanted to. You should know how to follow up. You can get access to a ton of content at ttifund.com. There's a contact page there that has links to all of our social media accounts, so you can get access to all of the content that we put out there, as well as the news. The blog page there has a ton of content as well. You can always reach out to Rita. We can schedule a one-on-one call. You can get her at 832-459-7335 or Rita at ttifund.com. Look forward to seeing you guys. We do these calls every week on Thursday at 7 p.m. Eastern. We were supposed to do one today on pre-IPOs, but we pushed it out of the way to talk about tariffs today. So we'll be doing pre-IPOs next Thursday. You can register for it at the same link. You just select, I guess it's April 10th, and you can register there. With that, we'll see you guys on the next one. Have a good one.